Is the personal lines exam hard? Welcome to the quiz. Concerning the additional coverage for debris removal in a homeowner's policy, how are expenses typically handled? Is it A, they are paid in addition to the policy limits? Or B, they are deducted from the coverage limit for the damaged property? C, they are covered only if a separate endorsement is purchased? Or D, they are only covered for fire losses? The answer is A. Debris removal is an additional coverage in standard homeowners policies that pays the reasonable expenses to remove debris of covered property damaged by a covered peril, and it is typically paid in addition to the policy limits for the damaged dwelling or personal property rather than reducing those limits. This helps ensure the insured can fully rebuild or replace without the cleanup costs eating into the main coverage amount. Deducting from the limit would reduce rebuilding funds, which is not standard. A separate endorsement is not required as debris removal is built in. It is not limited to fire only but applies to most covered perils. Because debris removal is an extra benefit beyond the main limit, this is how expenses are handled. Next question. If two insurance policies cover the same loss on a primary basis, which common other insurance clause might apply to determine how the loss is shared? Is it A, pro rata clause? Or B, excess clause? C, escape clause? Or D, primary clause? The answer is A pro rata clause in other insurance provisions shares the loss proportionally between two or more policies on a primary basis based on their limits, so each pays its share of the total coverage. Excess clause makes one policy pay only after the other is exhausted. Escape clause attempts to avoid liability if other coverage exists. Primary clause is not standard terminology. Because pro rata fairly apportions the loss among equal primary policies, this is the clause that applies. Next question. In property insurance, what is the key difference between a vacant and an unoccupied dwelling? Is it A, they are synonymous terms? Or B, vacant means devoid of all contents and people, unoccupied means people are temporarily away but intend to return? C, unoccupied means the utilities are shut off? Or D, vacant has no impact on coverage, but unoccupied voids the policy? The answer is B. Vacant typically means the dwelling has no people living there and little or no personal property contents, increasing risk and often limiting coverage after 60 days, while unoccupied means the insured is temporarily absent like on vacation but intends to return with contents remaining, so coverage is usually unaffected for short periods. They're not the same. Utilities off may relate, but is not the definition. Both can impact coverage, but vacancy has stricter limits. Because vacancy implies absence of people and contents while unoccupied is temporary absence, this is the key difference. Next question. Which of the following is not a standard deductible option in property insurance? Is it A, flat dollar amount, e.g. $1,000? Or B, percentage of the dwelling value, e.g. 1%? C, sliding scale based on credit score? Or D, split deductible, e.g., higher for wind/hail? The answer is C. A sliding scale based on credit score is not a standard deductible option in property insurance. Deductibles are typically flat dollar amounts, percentage of dwelling, or split for specific perils like wind/hail. Flat dollar is common. Percentage is used in some policies. Split is for seasonal perils. Because credit-based sliding is not standard, this is not a deductible option. Next question. Under a life insurance policy, the person who possesses the contractual rights, such as naming the beneficiary, is it A, insured? Or B, policy owner? C, annuitant? Or D, beneficiary? The answer is B. The policy owner is the person who owns the life insurance contract and holds the rights to name or change beneficiaries, borrow against cash value, surrender the policy, and make other decisions even if they are not the insured. The insured is the person whose life is covered. The annuitant receives annuity payments. The beneficiary receives proceeds. Because the policy owner controls the contract rights, this is correct. Next question. A dwelling policy, such as a DP1, DP2, or DP3, is most commonly used to insure. Is it A, the insured's primary residence? Or B, a condominium unit? C, a rental or secondary dwelling? Or D, a mobile home on a rented lot? The answer is C. Dwelling policies DP1, DP2, DP3 are most commonly used to insure rental properties, secondary homes, vacation homes, or non-owner-occupied dwellings, providing coverage for the building and sometimes other structures, but not personal property unless added. Primary residences use HO forms. Condos use HO6. Mobile homes have specialized policies. Because dwelling forms fit rental or non-owner-occupied situations, this is common. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.